Hey, everybody, and it's a happy new year. Hopefully. So, you know what? It's okay. Are we going to move something? All right. You know what? We haven't done this in a few weeks, so we are working on some stuff. But thank you for joining us. I'm Lee Seiler, also known as the Stock Doctor. And joining me tonight is, as always, the one, the only Miss Nikki Ward, and she always gets the applause. I don't know why she's not getting the applause. It's not working.
New year, same team.
All right, we're getting nothing going on, so.
Killing it.
Oh, okay. All right. So anyway, thanks for joining us.
Bear with us.
And let's talk about what's going on in the markets. All right. So look, we know what we had going on. We know that the market has been. Yes, thank you. I can hear myself now. Could everybody else hear us?
Yes. You just couldn't hear it.
Okay. Now I can hear myself. Okay. So now I want to introduce the one, the only Miss Nikki Ward. Okay. There's a lot of green on the background, but just so you know. But anyway, before you do that.
The bar looks not so great tonight.
Okay. So, look, we've been off for a few weeks. It was the holidays, et cetera, et cetera. But let's talk about what's going on in the market, Nikki. And it's it has not been good. Q4 was good. The markets were up. December was bad.
Santa Claus just skipped over Wall Street entirely.
However, the Santa Claus rally, the Santa Claus rally actually was correct, which was the last 5 days of December and the first 2 days of January. It actually was up, which is,
I mean, as of yesterday's close, the Santa Claus rally brought us 0.05% of a rally.
And the average is 1.3.
Right. And I mean, today we did end up positive despite, a lot of data out there. You had Fed minutes, you had a JOLTS report. I mean, we snapped a 2-day losing streak.
Yeah. And the Fed minutes were a little hawkish. It wasn't, I don't think it was horribly hawkish.
They came out and said there was not a single person that said, a single Fed president out of the 19 of them that said they were going to cut rates in 2023.
I believe that they are incorrect.
What?
Because they jump on bandwagons. And I truly believe that what's going to happen, because I did some studying over what the Fed has done. And
gotten it wrong.
The Fed has always gotten it wrong. So I truly believe that once, for example, 2004 to 2006, you had, and I'm going by 25 basis point hikes, okay? So I'm not going by the actual, because we have only hiked up seven times. I mean, in 9 months, we're up 17 times. If you were to go 25 basis points, the Fed has always hiked 25 basis points for the most part. They have there are situations that they go 75.
2022.
Yeah, but in 2022 has been miserable.
Right, and they just decided like 25 basis points was out the window, and it was 75.
And they had to, because they screwed up.
Yeah, they were late to the party. But in
Why?
2004,
Why?
Transitory.
Yes, transitory. Transitory is a word which we heard for how long? For
at least a year.
A year. That said, oh yes, inflation's it's here,
and
but we believe it's transitory.
And nobody knew the definition of transitory at that point.
Okay, we knew it was temporary, but
it ain't temporary.
It's not temporary.
No,
it's not. I can't believe you said ain't, because you're very proper in your English.
Well, I'm kind of throwing a little bit of slang here and there.
So here's what I think.
But wait, 0406, what happened then?
Okay, 0406, you had 17 rate hikes.
Oof.
And then what happens? The financial crisis, and they got to start cutting rates. Look, the Fed will. This is the ebb and flow of the economy. The Fed raises rates when the economy gets too hot. The Fed cuts rates when the economy starts to cool. And this is what happens. This, in my opinion, is a very mild situation, unless there's a black swan, and that black
Exogenous
swan
shock.
could be, well, the pandemic was an exogenous shock, but the black swan could be China, Taiwan.
It could be. Geopolitically, there is a lot of uncertainty out there.
Yeah.
I will also say, though, what's kind of refreshing to me is that something I heard today was about how, in 2000 to 2002, tech, they just absolutely lost their shirts in tech. And then the next time that the economy slowed down and we saw a recession was 07 to 09, where tech did really well, and then for the next decade outperformed, while financials really bore the brunt of that. What's intriguing to me now is financials, which I feel like every year they're like the Dallas Cowboys of sectors, because every year I hear financials are going to be so great, but they are in such a position of strength.
But they lose the first playoff game.
Absolutely.
Every
they
time.
Don't even make it to the playoffs. But so financials, though, banks specifically are in such a good position as far as their reserves, so that we know no matter
strong.
what, they're going to do well. And maybe that's something to look into this year as we move forward. The economic and business cycle that we're moving into is not the one we've been in for the last decade.
Look, last year's market was miserable. But it wasn't like some of the bear markets have passed. It wasn't that bad. I mean, we're down 20%. Okay. So you're down 20%. That really is bad. But hopefully you had positions that maybe could have either, we believe we're going to have some rebound there, or but bonds didn't save you. Bonds were down 15% in general.
2022 is the worst combined total return for stocks and bonds since 1872.
Yeah, well, the worst bond market in history. So let's talk about 2023. We want to forget about 2022 now. And
it's in the rearview mirror, baby.
2023, I believe, and look, nobody knows what's going to happen. Nobody knows whether we're going to be up or down. But we only have history to kind of help us.
It's a guide.
And what we do know is that only 4 times in history has the market, calendar to calendar, talking calendar year.
We're talking back to back.
Has gone down 2 years in a row.
Consecutive, yeah.
So 2 consecutive years has only happened 4 times. And it has happened in
the Great Depression,
2020, 29, the 70s,
2000.
08, 09. I'm sure that was actually
that was the fourth.
Okay, well there was only 4. I can't confirm because I think there was something of like early 40s actually before the First World War, but I wasn't sure. I thought
it was Great Depression.
I thought, by the way, I thought it was 08, 09, but it was.
Is it 07, 08?
Maybe. Anyway, it's only happened 4 times. 4.
Okay.
I do know that. So 4 times in history of the stock market that they've gone down 2 years in a row. So there is a high improbability that we're going to go down this year. But that doesn't mean, and I kind of think that we're going to be in for a rough patch the first 6 months. We may go and because first quarter earnings are going to come out starting this week, actually, and next week really start hitting it hard. They're not going to be that great.
I don't know if this first quarter, because it's looking back at the last quarter, which has the holiday season into it, and a lot of companies get a boost from those sales. However, I will say that I think Wall Street is kind of in 2 camps right now for 2023. You have a continuation of just a Fed-driven story. You also then have the earnings apocalypse. And it's either one of the two that you tend to fall in. And if you think it's a Fed-driven, you're kind of believing in that whole soft-ish landing kind of thing. If you think that there's an earnings just catastrophe waiting for us, then you're going to see it reflected in the stock market. We've already seen what higher interest rates have done to equities and to bonds. And all that's left out there is earnings. Can earnings maintain, or can they also to not do as badly as they are feared to do?
Well, we're seeing a lot of downgrades on earnings. and
That's
price
all
targets.
lowering the bar.
And look, this is why Apple is down big and Tesla's down big and Microsoft is down big, because rates are up. People, the negativity out there is
rampant,
enormous.
That's like a theme I felt like of 2022. It was just pessimism.
Yeah, there's a ton of pessimism. And that's probably going to continue for a little while.
Yeah.
But I see the retail selling going into it now. You know, we have a new year. So energy stocks sold off the first day of the year. Why was that?
We have this mean reversion where everything that worked last year, not working this year.
But
everything that didn't work last year outperformed. The NASDAQ was up today.
Yeah, but energy stocks sold off first day of the year only because there were some profits there.
Yeah.
They offset their portfolio with losses, and they said, okay, let's buy after the first of the year. So that's okay. I think energy is still going to work. I do believe that.
I think you need to have exposure within your portfolio.
Energy, healthcare, those guys, they're going to be okay. The key is finding where the rest of the market is going to move money. You know, technology, it's going to be in the crapper for the next 6 months.
Without
Probably.
a doubt, which also raises the point that now is the opportunity it's 2009 all over again. All of the amazing technology stocks that you wish you had gotten into in 2009,
I agree.
Amazon, Alphabet, if you're a Meta person, that's on you. I mean, but all of these tech companies, and I'm talking about the ones that are verbs, like a Google, like Amazon. I mean, those are not going anywhere, and now is an amazing time to get into or start building a position at a discount.
Yes, but I want to make sure you're clear.
You have to have a long time horizon.
Yeah,
this
because
is not a 2023
buying, and let's go to let's do a screen share. By the way, let's go to a Google.
You have the charts if you want them.
Yeah, I can do that. Oh, I can do that too. Yeah, I know. I'm going to do this though. Google.
Oof.
It's miserable. I mean, look at this chart.
That looks awful.
Stock closed at $88. I mean, I like Google. It's cheap. It's a place where you want to be. And we'll do it here. Yes, you're right. We'll do this one. Okay, let's go here. Google. All right, so Google's in the crapper. Let's show the downtrend. Oof. We're here. It's been terrible. But I think it's cheap now relative to where they are. And I think you have to pay a premium as an investor to have that kind of stability in earnings.
And that premium could be time or it could be price.
Well, one thing is, if we have a recession, everything gets hurt. And we probably already had the recession, and the market's already adjusting for that.
And listen, if you have paid attention at all, I mean, big names on... in corporate America, I'm talking like Jeff Bezos, you've got Jamie Dimon, all talking about how you're going to see, you've got to batten down the hatches because, you got to get tight in the belt. Yeah. But these opportunities are not going to be around forever. And this is a great time to start building those positions. But you also, too, have to be looking at the long game. This is not something that's going to turn around overnight. And tech is not going to be the darling that it was for the last decade.
It's not. And
it's
that's
not
why.
High flying.
That's
these
why
are quality names.
That's why it surprises me about Microsoft. I mean, there's a chart of Microsoft. It's been terrible. I mean, and yes, because today they came out with Azure, which is their web services, is going to be a little bit
softer than expected, blah, blah, blah. And this is also going to punish Amazon as well because AWS is a main driver of their profitability.
Yeah, and Amazon will go there. They've all been doing...
They all look atrocious.
Yeah, they look terrible. But at some point, there's going to be a value there. I mean, Amazon is trading... that one's trading kind of high still.
Yeah.
But Google's trading at a low multiple, and the other one's trading at a low multiple. I mean, I think that the market gets overdone.
Of course.
And when it gets to this point, people start saying, I'm going to dump everything, and I want out of this, and they throw in the towel. And I love that. I love this time. I mean,
I hate that. I hate that people feel that way.
I love it.
So if you are feeling that way, I've got you can take two avenues. You can either call a financial professional who's a fiduciary who can take the emotion out of the investing and handle this for you, because that's what they do, or you can get the F out of the kitchen because you just can't handle the heat.
Yeah,
and that's okay too.
And my point is, I love that everybody's so negative, because I know that in the next year or so, we're going to have a big market rally. This is what happens. All right. Yeah. We have in history 4 2 down years in a row. We have had in history that the third year of a presidential cycle, when you have a midterm election, the market is up 100% of the time in year 3. This is what we're entering in 2023. Yes, we have the big stocks in the S&P 500 that attribute to almost 25%. Well, they used to.
They have an outside.
They don't anymore. Meaning Microsoft, Apple, Google, Amazon, Tesla. They're getting hammered. At some point, and I'm not telling you to go out and buy them today. I just think you can hold off. Let's see if I'm trying to bottom.
That's really key, specifically on Tesla. Yeah. Like, I don't see it bottoming, but I do know that it's at a good value. I'd be tempted to start building my position now.
Yeah, I had a client said, "Hey, I want to buy Tesla. This cheap." So we picked some up at 112. I mean, that's just what it is. So I mean, is it going to work out?
Eventually, absolutely.
But this is a chart on Tesla. It's a disaster. Major downtrend. Look at this. Major downtrend. Breaking all lines of support.
But and I know that everybody is so negative, and I agree with you. When everybody is negative, I'm like, all right, let's go buying.
Right.
Like, that's when I'm like,
that's kind of what you want as an investor, as a smart investor.
Yes, absolutely. When there's blood in the streets, that's when you want to be buying. Because you make the most amount, you acquire the most wealth during a bear market. It just doesn't feel like it. But with Tesla specifically, there is a lot going for it if they can get the Cybertruck out and into, the public sphere. They have talked about doing a lower cost, like a $30,000 to $40,000 EV range. That's something.
I'm not crazy about that.
I'm also not crazy about the fact that they do not have any pricing power. If anything, the market is dictating them lowering their prices.
They're having lower prices.
Discount for the first time ever to people that were willing to accept deliveries by the end of 2022.
But I also think that they were also pricing it up because they could.
Without a doubt, they were first mover advantage.
They could because they were the leaders,
right? And
they still are the leaders.
They're still the leaders, but now every legacy automaker is getting into the space.
Yeah. All right, so let's take a look at what happened today. All right, let's go there. I don't know if you can see it, but I have it highlighted right here. The Dow Jones up 133 points at 33,269. The S&P 500 up 28, 0.75% at 38.52. The Nasdaq up 11/16 of 1%. My fractions weren't quite right. 11/16 of 1%, 71 points at
they get a little dusty when you don't use them.
I know, 10,048. We haven't done this in a while. So look, here's the thing, folks. You have to stay in, because we've said this along, and Nikki says this all the time. It's not timing the market, it's time in the market. And I was on the air today with I recorded a show today with Justin Warmoth of Channel 6
that you can find Sunday morning at
7:30 on Channel 6,
or you can DVR it, because I'm not going to be up at 7:30 on a Sunday.
Yeah, I'll be up.
I won't.
So we talked about what's going on, and we said, listen, if you stay in the market for one day, if you played the S&P 500 for one day, you would be up 53% of the time.
I'll take that.
That is a crapshoot. That's going to Vegas, rolling the dice. That's just betting on.
It's a little bit better than Vegas, because I feel like the house always wins
slightly
in
better.
Vegas. Yeah.
I mean, if you play craps, you're really close to that. So, however, if you held the S&P 500, or you had time in for 3, 5, and 10 years, you'd be up 87, 92, and 97%.
I'll take those odds all day.
All day long.
And I mean, I think it's really important to remember that the United States stock market is the greatest wealth engine ever. And it has everything to do with time and nothing to do with timing.
Yeah. And you know what, though, Nikki? Here's the problem. Is that
my generation is impatient as hell.
Yeah, but crypto lost $1 trillion last year.
Yeah.
$1 trillion of worth gone in crypto.
How much of our portfolios were exposed to that?
I don't say zero because we had a few people that had a little bit of something, but it was a fraction. It was a fraction of one. No, not the tokens. It was a fraction of 1%.
I mean, they might still be holding like a Coinbase position, but
I don't think even that. But it was a fraction of 1%.
I mean, maybe us because we have the Grayscale Bitcoin Trust.
But again, a fraction of 1%.
Correct.
Because I'm not a believer, and I haven't been a believer.
And it's just too speculative. It's too young. It's too infantile of just an asset class for us even to take seriously.
So that didn't work. But
NFTs? Oh, wait. Those didn't work either.
But Apple, which is our largest holding, down $1 trillion also.
Yeah, but just recently. Are they giving up the strength that they have maintained?
Outperformed.
Yes.
It outperformed the NASDAQ until recently. And
you gotta think they're sitting on mountains.
All right, I want to say this before we head out. And I told this to Justin today because I noticed he had an iPhone like you do laying on the desk, just like him. Just you. You, Justin Warren. Yeah, Apple Watch. Okay. So if you were, because you don't have an Apple 14.
I have the 12.
Okay. So you have Apple 12. So, but a lot of people do upgrade more frequently than you.
Yeah.
You don't upgrade as frequently.
No, I don't care.
Okay. So if you were going to go and get an Apple 14 and you said, I'm going to order for Christmas, let's say for your boyfriend.
Uh-huh.
Okay.
I'd have to make sure his boss wasn't going to get it for him too, though.
Okay. Yes. Okay. All right. Sorry about that.
That's all good.
So you say, all right, I'm going to get Matt an Apple 14, and all of a sudden you can't get it. Mm-hmm. And you're waiting, or I think it works better for yourself.
I also think because he's a Samsung guy, but also too, I will sit and I will wait.
You'd wait. Would you change
every single
infrastructure in your life? Would you change your ecosystem?
Well, Apple has me in a chokehold.
Yeah,
and
that's
I wouldn't
the thing.
change. But I will say, Matthew, who is in IT, super into tech, loves that side and researching things, he even admits that the best tablet that is out there on the market is Apple.
Really?
Yes, and he is, after playing with mine, contemplating getting one. So he might deviate from the Samsung ecosystem, but he won't then.
So, but that's possible.
But
then
he's
people
not
do
going
that.
to change everything. Like he's gonna, because he's got the watch, he's got the Samsung phone. He's not gonna go straight Apple.
Okay. Well, I know people that have gone from Samsung to Apple.
I don't know any.
I don't know very many people that have gone from Apple to Samsung. I truly don't know this. No. You know why? Because they have the ecosystem. And
Apple keeps you there.
And the stock's in the shitter.
But I feel like there are a lot of stocks that are broken stocks or broken sectors or just a broken economy. And that's what the Fed wants. That's the thing. That's the main theme, unfortunately, that we're going to also take into 2023.
The Fed
is that they want to destroy demand. They have to.
They want to break wealth.
Because they need inflation to come down. They cannot allow what happened in 72 to 73 to happen again, where inflation got out of control.
Let's take a look at Apple here. The tops, hit 178 back in August. You had the high of 183. It's 184 or so. But now here we are at 126. I mean, it broke a major support level right here, and it broke that 129 level. It did it all. You had volume yesterday that took it lower. I mean, I can't say one good thing about the technicals of Apple. The chart looks like an abomination.
Technically speaking, I can't add anything positive. I will say, though, because Apple, like what has happened within our practice, where Apple has grown to be our largest position, right. I think because we had, within a crappy year, we also got to take advantage of tax loss harvesting. You're offsetting some of the gains that you have absolutely seen in Apple if you've been a holder for 5-10 years.
But we didn't sell any Apple. I know this because I do that kind of trading.
But I think part of this recent downturn has been
and I think that we're probably
taking
some
profits off the table.
Look, we've owned Apple for a long time, and we bought Apple originally in 2010 or 11. So
At $11.
we have people that own it at 11 and change. So
That's my favorite. I love looking at that.
I love it, and but it's been terrible. I mean, but I believe that you can't be so impatient, and the problem is people get impatient. And they say, "Why hasn't it moved today?" But if you buy quality, and I like to say this, buy quality and you hold it, it's something you want to own, not to rent.
Yeah.
And I think at these levels, a year or two down the road, you're going to be happy. Just like I feel with Disney too. Same thing.
I was going to bring that up next because I agree with you on Apple, and I think it's a quality hold. And also too, I mean, I will give a little bit to the everyday retail investor that within from 2020, March of 2020 to now, they have been through the ringer, and they've seen, a drop of 34% in March of 2020. Then they got this exorbitant, rise in everything, and there was just bubbles and frothiness, and now we're coming back down to earth. But things like Apple and Disney and Google, like, they're not going anywhere, and they are being punished because of the fact that they are a part of the S&P 500, not because they did anything wrong.
It's
themselves.
Things are getting overdone, and
yes,
I'm not sure where things are going to clear out. The
it's
S&P
not going to clear out for every company of the S&P 500 all at the same time.
Yeah, and the S&P closed today at 3852. There are a lot of folks out there think it's going to 3,500.
We could
going to
go back to those
3,200.
October lows.
Yeah, the October lows are 36. Let's verify that, but I'm looking at it right now.
I have it. I just can't see.
You do have
October
it.
October 12th, it closed at 3,577.
Yeah, so 3,600-ish.
Yeah.
Actually, we had a 30 in October. We got down at 34.91.
I'm talking about closing.
Yeah. Intraday, we get down at 34.91. So
we could retest.
Could we do that?
It's only like 10% or 9% from right where we sit right now. It's not really that far to go.
Yeah, I mean, here's the S&P 500.
That.
So you could see this, that down here at these levels, that's at October lows. Octobers are a shitty month anyway, but
they are.
Anyway, I do think that.
And we've been in this trading range right around 3,800 of the S&P 500.
So I want to end with this. This is not an economic meltdown.
No.
Barring any black swan.
And this is not people can't afford their homes using phantom income to be put into mortgages and loans that they can't afford.
No.
This has nothing to do with the financials of the economy or the consumer.
This is a Fed-driven recession in which the Federal Reserve knows that they made a mistake and they're having to raise interest rates expeditiously so that we can curb inflation.
And I hate to do this because but it's also, we are suffering the ramifications of putting $1.5 trillion into people's checking accounts. You cannot
That's
do
going
that.
away, by the way.
Right, but we already did
M2
it.
money supply is basically gone.
And that's wonderful. That is proof that what the Fed is doing is working.
Yeah.
But it's just the fact that you can't do something like that and not suffer any consequences. And now we're paying the piper. And the Fed is the face of this.
Well,
punishment.
The Fed this is a Fed-induced recession, which we may have already been in. If we're not, we're gonna be in.
Yeah. But it's reassuring to know that the companies that make up corporate America are, while they're defensive and they want to, lower the bar, they're still doing well.
Yeah.
We still had record earnings in 2022.
Yeah, and we'll see. Look, earnings going to be
down,
flat to down.
And they're not going to be the kind of multiple expansion that we've seen over the last 5 years, but I don't think that they're going to fall through the floor.
All right, we really appreciate you guys joining us on the Hump Day Market Update. For Nikki Ward, I'm the Stock Doctor Lee Seiler. We'll see you next week.